Welcome back to the Reagan RedZone. I'm your host, Webb Milward. Joining me today in the Red Zone are two of our partners at Reagan, Brian Deitz and Brian McNeely. Gentlemen, welcome back to the Red Zone.
Thank you, Webb. Glad to be here.
Yeah, glad to be here. Glad to see you guys aren't wearing matching vests this time. So
we're going to dive right in today. We've got two topics we're going to cover. Each of you are going to lead us through these topics. The first, Deitz, is coming your way, which is really to talk about the current M&A market. We're about halfway through the year, and I think our listeners would enjoy an update on what's happening in the market and where does it stand right now. Highlighting that is the news last week that Brown & Brown has acquired Risk Strategies. This is the fourth, quote-unquote, mega deal to happen in our industry in the last 14 months. The fourth deal of continued consolidation amongst the top 20 brokers in our industry. So again, these sort of tectonic shifts that have a lot of implications in the market. But let's use that as kind of the linchpin and get your thoughts on what impact will that have on the market, and where does the M&A market overall stand right now in your mind?
Yeah. No, it's an interesting question. Those four mega deals represent $45 billion of acquired value. And that is a lot of investment in insurance distribution from institutional and publicly traded investors. At the same time that we're seeing those deals take place, we're actually in a market where the number of announced deals is declining. If you go back to the peak in 2021, there were almost 1,000 announced deals, and we finished 2024 with 587 announced deals. So it's a pretty steep drop off. Now, there were some macroeconomic conditions, obviously, that drove 2021 with tax changes, et cetera. But we are in a declining deal environment. And if you look at the announced deals so far in 2025, in Q1 of 24, so last year, we had 135 announced transactions. And then in Q1 of 2025, we had 100 announced transactions. So a continuing decline in the number of announced deals, yet some massive investments in some large transactions. And I think where this all boils down is that the M&A market is still in a pretty strong place. There's still significant demand for acquisitions, but the number of deals is going down, and there's a lot of reasons for that. There could, and I'm not sure exactly if there's one right answer. I think there are fewer buyers announcing deals, and so that there are more unannounced transactions than there have been in the past. I do think that there are a reduced number of sellers in sort of the target zone, and that, certainly I think is having an impact on the supply side of the equation of mergers and acquisitions. And then finally, you could make the argument, I think, that with firms like Assured Partners and McGriff, Truist, and now Accession Risk Strategies, 180 intermediaries being taken out of the market, that the number of buyers, sort of volume buyers, is declining. And so could that be contributing to the number of announced deals as well? I'm not sure. I think it's probably a combination of all three of those. But I think despite that, I still think the M&A market's in a pretty good place.
McNeely, any reaction to that kind of opening comments?
yeah, I mean, I would agree, and I would. So when I'm in the market, I sure don't hear a lack of people looking to explore what their options are in the market, and I don't hear any of the acquirers in the market saying, "Hey, we don't have enough activity right now." So it seems like everybody's plate is pretty full as it has been. I think I might point a little bit more to, is the data that we're quoting correct? And I would say, we know for a fact that some of the major acquirers aren't announcing deals any longer. Some have never done it. I also think that just given the number of smaller transactions that are being done, those are flying under the radar, so they're just not being reported. So I really question the underlying data, and it's not a function of whether the data is being collected correctly. I think it's a function of it's being collected correctly. It's just not there to collect because people aren't announcing it in any form or fashion. So I think that's what's driving a lot of this activity.
Yeah, and I think we should point out too, what we're quoting here is deals from SNL, S&P Global Market Intelligence, and we're using their reported figures so that we get sort of an apples to apples look at transaction data. And I think Brian's right that deals are still getting announced and they're still getting recorded, but it's a smaller percentage of the total transactions that are getting announced. And that is influencing these numbers for sure. But I still think that there's something in the supply side of the equation. And I've had representatives from large brokers say to me, it feels like the middle of the retail insurance distribution system is a little bit more hollowed out than it has been. There are still the large firms, there are still plenty of small firms, but the mid-sized firms, kind of 10, 20, 50, 100 million. There's a reduced number of those. I've had another large acquirer say to me, yeah, it seems like everything we see is either 7 or 8 million or really, really big. We're not seeing a lot of the stuff in the middle anymore. So I do think that the just based on the consolidation activity that's taken place over the past 7 years, there are fewer of those kind of really attractive $20 to $25 million firms entering the marketplace now.
So let's play that out. So if there are actually fewer deals being done, if that's actually the case, how do we explain, well, what does that mean for the acquirers that their business thesis, their business is built around doing deals? Are they struggling right now? Is that what we're saying? But because the other hand of that is if they're still having to maintain that acquisition mandate and there's nothing in the middle, then that would indicate that they're having to acquire smaller firms. And to maintain the same volumes, they would just have to do more smaller firms to keep their M&A line of revenue growth where it needs to be. So does all this mean that the private equity backed brokers, which are the ones primarily that have the M&A thesis, that they're struggling?
I don't think so. Remember, just because there are fewer doesn't mean there aren't any. So I still think that there are firms out there in that size range that are going to be in the marketplace, but I don't think there are as many as there were in 2021 and 2022. And I think therefore competition for those deals is significantly increased. And I think that I agree with you on the primary explanation for deal totals is what's getting announced versus what is not. But I also think it's important for the market to note that there's not a never-ending supply of $25 million acquirable firms. And I do think there are fewer of those today than there were. But no, I don't think the acquisition-based business model is in jeopardy here. Zooming out to a macro perspective, we're still dealing with an incredibly fragmented industry with market share spread throughout the continuum of agencies. So there's still a lot to acquire, and there will be for quite some time. I'm sort of talking about one particular segment of the market, and could that be contributing in some small way to the lower deal totals? I think it's possible.
There's also the lift-out phenomenon.
There is also the lift-out phenomenon. Yep. Talk about that for a second. What do you mean?
Yeah, just producers with large books being lifted out of their current employer, sitting out, hopefully, their non-solicit, and then being compensated for at the same levels they were before they joined their new firm. But then once their non-solicit expires, they then go after their old business. And people are willing to pay large premiums for those producers or guarantee large salaries and provide some additional sweeteners for those mega producers that are in the market looking to make a change. So there's been discussions around some of the buyers dedicating portions of their M&A teams that is all they focus on. So they don't even focus on M&A of agencies. They have people on their team that are focused on acquiring or lifting out large producers or large producer teams.
Go ahead, Mac.
And I would guess that most of those aren't being picked up in any of the transaction counts that we're seeing.
And is that phenomenon connected to the sort of barbell dynamic that Deitz outlined? If the only deals happening are mega deals or on the smaller end of the market, and you're an acquirer with a big appetite and the middle is not there as much for the taking, is that connected in reaction to the fact that we just need to get out there and acquire more talent, and we're finding it in these sort of seasoned, experienced producers?
I don't know that it's an offset. I think it just might be some ways easier and less risk.
I think there's an economic incentive to it also. I think that in most cases you can get a lift out to come over at an incremental margin to the acquirer at a 40 or 50% margin, which equates maybe to a 6, 7, 8 times EBITDA multiple. And if you're doing an agency acquisition, your ability to do something at 6, 7, or 8 times EBITDA is pretty limited. And so I think there's an economic incentive to lift outs that the market hasn't quite sorted out yet. The other side of that is generally it's just so tough to do lift outs at scale. There have been, but there aren't. We talk about not many $25 million agencies being available. There are far less $25 million lift outs being available. So you've got to do them more one at a time. But I do think that there's an economic advantage. And Brian, you're right. This could be very much, if there is a considerable market shift toward lift outs as an inorganic growth strategy versus agency acquisitions, then yeah, that could affect deal numbers today and going.
And then from the perspective of private equity, as we kind of round out this M&A discussion, there's obviously no shortage of PE interest in our industry, and certainly calls we get every week from new sponsors looking to break in because they see some of the dynamic. How do you think they react to the news of something last week with Brown & Brown Risk Strategies, and how does that maybe shape or reshape some of their strategy as they either look to enter our market or maybe look to buy another asset?
I think for the private equity guys, it's a good thing because it gives them another exit option.
Yes.
So now they have strategic exit option, they have PE swap if that's available, trade option, and they have the public option if they're big enough. So, gosh, I think they welcome it. I will say, but here's the caveat to that. So going into the year, this has somewhat been the year of integration in some ways, where we've seen the market look at firms and reward those that are integrated and not reward those that aren't. You've now got these huge deals that are in full integration mode, and Brown & Brown's about to be kicking up integration with Risk Strategies, which is something they haven't done in a while, certainly not something of this size. It's probably back to the Beecher Carlson days when they did something even close to this. So it is the story to be told of these mega deals, and ultimately what their impacts are, how well these businesses are integrated, hold together, and what results they produce for the strategic acquirers that acquired them.
Yeah, I think that's exactly right. The exit is always the primary concern of the investor, especially the private equity investor. They don't get paid and return to their limited partners until they exit. So an increase in the number of viable exit strategies is always a good thing. To your point about wrapping up on this topic, I still think that given lift outs, given a potential hollowing out of the middle of the market, we're still in a place where there's aggressive demand for agency acquisitions. And I think we should look at, as an industry, these mega deals as an indication of demand, not necessarily a warning sign that some activity may be slowing. And if you think about Gallagher's Q1 earnings call, they mentioned in the earnings call, hey, look, even after, the Assured transaction, we've got $2 billion of free cash flow for M&A in 2025 and $5 billion in 2026. Those are huge numbers, and that's just one acquirer. So I think the funding is still there from certainly the publics and from a private equity perspective. And I think valuations are still there. You've got public brokers trading at 18 or 19 times EBITDA right now. And with valuations at those levels, they can afford to do a lot of deals and a lot of accretive transactions. So I think that overall, the dynamics are still lining up, and it's interesting to see that the numbers of deals, quote unquote, declining from an announced deal perspective. But man, it does feel like it's still a pretty strong marketplace out there.
Yeah, values haven't changed. If that's anybody's question, they've definitely held. We're agreeing on way too much.
Well, I was going to end this segment with just a reminder of a previous disagreement for the listeners. And that was you and I had a conversation about the number of mega deals that would happen in 2025. You said 3 or more, and I had under 3. We're in June and we've had 1 so far. Are you still feeling confident that we're going to have 2 more mega deal announcements in
There's a lot
2025?
of time left in the year.
I know. I'm asking you how you feel about that at this point.
I still think there's a couple out there. If not, there might be a couple hangovers in the early next year, but it's coming.
Oh! So now just change the terms of the bet if it's not going totally your way. Change the timeline. Is that the strategy?
That's
Well,
learned that from
please
you.
note this for the
Learned that from
record.
you playing every game we've ever played.
We'll have our producers fact check what happened in the last conversation to make sure we're still in line here. No,
Yeah,
look,
we need the ability to go back to previous auto clips. We might need to get Benjamin, our producer, on that.
but it is an interesting question that I think we will continue to watch, and certainly I know our listeners will too, just given the impact it has on the market overall. But look, great segment there, good analysis. So let's pivot to topic 2 here. Another big theme being discussed in almost every meeting we have over the last 5 or 6 months is kind of thoughts on the market and whether or not we're headed into a soft market. And just to give you all and our listeners a little primer here, we are currently 31 quarters into a hard market. The current hard market began in the fall of 2017. It's about 31 quarters where we've enjoyed this kind of hard market rate environment. For context, the hard market that preceded this one lasted only 11 quarters. So we are almost 3 times longer in the tooth on this current hard market than the last one. And so naturally, there's a lot of commentary about where are we seeing pockets of deceleration or softening in the market. Maybe we are, maybe we aren't, but I think it would be interesting for the listeners to talk about here at the midway point of the year. What are we seeing with regard to the market? And Mac, let's let you lead off here. What is your take on the topic?
Yeah, I think we're definitely entering a period of time where rates will not be as hard. So the increases year over year are getting smaller. I'm not saying that the overall rate environment is going in a soft direction, although I was with a top 20 broker last week, and he told me that his prediction was that the market was actually going to go soft, which I clarified. I thought that was fairly aggressive. But you look at the information released by the CIAB. The most recent was 4%, 4.2% for the first quarter. So that's materially less than some of the 9s and 10s we were seeing. And when you kind of look at the data, there's some pretty broad areas where the rates are swinging pretty big. There were actually, if you look at by line, there were 5 lines that went negative in the first quarter: workers' comp, cyber, D&O, employment practices, and terrorism. So they were actually showing a negative growth rate. I think for some others, you're still seeing the commercial auto still kind of leading the pack. The general liability is what everybody still talks about and the issues that's surrounding it. So my thought as I've thought through this is I think the rates are definitely getting less hard. And I think that's a function of we haven't really had any material natural disaster events most recently. So we haven't had those. I also think that maybe this is a function of the insurance companies being able to understand and write risk better and price them correctly. I've heard several clients talk about this isn't the good old days anymore, where you could call the underwriter and talk them into doing something that they might have not otherwise done without some encouragement. But I think the ability to do that is getting a lot less. And I think that's at least part of what is driving the rate decreases we're seeing.
Do you have a reaction to that, Brian?
I mean, unfortunately, I agree, but it feels to me very schizophrenic. And when you the CIB has great data and they're sort of the source for this stuff, but their Q1 headline when they released their rate report is most lines of business softening. And I feel like we just need to talk about this and clarify definitions. Most lines of business soft would be most lines of business are negative, which is not the case. More lines of business in Q1 were up than they were down. And so softening doesn't necessarily mean soft. It means that they are less firm than they were in the last quarter. And I think that is true. But again, it's all over the place. And that's potentially one of the reasons that this hard market has persisted, is that we've had different categories of business have different rate increases throughout this period. We had, D&O and cyber just, skyrocket for a part of it and then down, and then property was up and now down, and we've got auto up now, and the personal lines rate environment still continues to be, pretty dramatically firm. And so I think with all of the different lines of business kind of moving in different directions and softening and hardening at different times, I think we could have a much longer actual overall hard market. But there's no question that we have less of a tailwind as an industry than we did. And you can look at the GPS data and see that. GPS numbers in Q1 of this year was a growth rate of 7.9% versus a Q4 growth number of 9.0%. Now, brokers in Q1 of last year grew at 8.4%. And then managed to accelerate throughout the year to a 9% growth number ending. But if we're starting at 7.9 this year, which I think is reflective of the less firm market and a less robust tailwind, where do we end? Brokers have projected 10%, and that seems aggressive to me given where we're starting and given the lack of tailwind. But I think we're in a period where, sure, the tailwind's diminishing a little bit, but I don't think we've got any headwinds at this point. And I'm not sure that how fast we'll actually have headwinds.
That was going to be my question, is would either of you care to kind of project or predict when we might see a negative number, even in one or two lines of business?
And we're seeing that in some lines of business now.
That's right.
Now, I'm not sure where that falls in Deitz's definitions, where he was given his overview there. I'm not quite sure what firm is and how firms differ. Is firm less hard? What does firm mean?
Firm, hard, all of those are positive. Soft, down, those are negative.
Harder than hard, harder than firm.
It's harder than hard. What's going on here?
I'm just trying to understand.
SEC English class?
I mean, I think we, as the insurance companies get better at their pricing models, I think that will be the primary, a big driver of the pricing in the market. I think the other thing that's just hanging out there is, while we talk about this, if we had a Katrina type an event later this summer, the whole thing's turned upside down again. And we're not having this conversation for a long time. I think trying to figure out when the market actually starts decreasing as a whole in aggregate is incredibly challenging.
Yeah.
And I think it's farther away than what people would think. Brian, your conversation with leadership of a top 20 broker saying that we're going to have a soft market relatively soon is an interesting data point. I would not have probably said soon. I think we could be in a still a technically hard market where rates are up, through the remainder of this year. And that's firm. Correct. We could be in here for a while, and it could just be kind of slowly moving towards soft. But I also think that this does not need to be a huge area of concern for brokers. We've got things in the marketplace that can counteract that and that have counteracted that. And if you go back to 2014, 2015, where we had, technically a soft market where overall the rate environment for P&C was down, we still had brokers growing at 6 or 7%. And things like employee benefits and things like economic growth can counteract P&C pricing. So even if we do get an actual soft market, I don't think this spells doom and gloom for brokers. It might spell the end to, average double-digit organic growth rates every year. But I don't think this is a, falling on hard times story.
I don't think it's doom and gloom. I just think could potentially be, even if it didn't go soft, we have 1 or 2% increases in aggregate. That is a different environment than some of the producers in our clients' firms have ever operated in. There's some producers in our clients' firms that all they know is a hard market, and one that's been pretty hard. So it is an adjustment, because while it's not doom and gloom, it is a headwind that people will have to deal with, and it will put pressure on organic growth.
Totally. Agreed.
Yeah, that's interesting to me. I mean, you make a great point. You could be 8 years into your career and never have experienced a soft market or anything resembling it. So as you think about privately held firms and some of our listeners today, what do you want to focus on if this is potentially coming down the road? And I think a changing market, right, will absolutely emphasize the importance of a true sales culture, will further heighten the importance of focusing on sales velocity and your ability to get up every day and just write new business and not worry about some of the converging factors around you. And so I think it's a really good thing for people to think about. To me, listening to you guys, it's starting to harken on the recession conversation that we've been having for 2 years of like, here comes the looming recession and here comes the soft market. And makes me want to ask you as part of our closing question here, what will happen first, a recession or a soft market? Or neither? You could answer neither.
Well, one of them's going to happen first, Webb. That I feel confident in. I would pick soft market before I picked recession.
Okay.
I think I would do the same, unfortunately.
Yeah.
And the unfortunate is that we're agreeing again.
Yeah, this is the most amount of agreement between you two. Oftentimes you're like siblings and it's impossible to have you agree, but this has been very cordial.
Good work, Brian.
We're mellowing in our older
You're
age.
maturing. You're maturing. Well, look, thank you guys for joining the Red Zone today. I think it's really interesting at this time of year, almost the midway point of the year here, to think about these big picture items and just appreciate the analysis and the thought process around it, and for joining the conversation. Look forward to seeing everyone again the next time we jump in the Red Zone, and thanks for listening.
Thanks, guys. Have a great one.
Thanks, Webb. Thanks, Brian.